Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we continue to work through this first week of trade in 2023, we saw in the markets a little bit better showing than the past couple of sessions, but still some downward pressure at some of these commodities and plenty of things to talk about here with our good friend Bryan Doherty, Senior Market Advisor at Total Farm Marketing, and he is our guest analyst here on the show today, and we appreciate him taking the time to join us. And Bryan, I will wish you a Happy New Year, sir. I hope you're doing well. Thanks for being on.
Jess, thank you very much. It's a pleasure to be on. Nice that we're into a new year, and nice that we can keep working together. So it's a pleasure. Definitely.
Well, I echo the sentiment there likewise. And, looking at this market on Thursday and really just the tone all week long, like I alluded to, a little bit better showing, but still not great. More pressure at soybeans. Spring wheat looked like it helped pull the wheat market and maybe corn too back towards unchanged. But overall, Bryan, this tone, this risk-off kind of tone to this market, a lot of funds getting out, it appears, and liquidating long positions. It's just been a rough start to the year for the grain and livestock commodities.
It has. And we saw, let's start with last week. We saw good price activity last week. In particular, we saw both corn and beans really claw higher, and even wheat had some good days. And then on Friday, the last trading day of the year, we saw that corn actually posted what's called the bearish key reversal. It was down a penny on the day. It still picked up 12 cents on the week, but then we lost 8 or 8.5 on Monday, and bunch yesterday, 15, I think it was. And they were losing a penny. So 3 down days in a row. I'm going to summarize it. I'm not bearish on a lot of these markets, but I'm just concerned. I'm concerned because it seems like we talk about that buzz kind of phrase of risk off. Well, what does that mean? Well, it just means people don't want to take the risk. And it's just not in corn or beans. It's in wheat. It's in livestock. It's in the equity markets. It's in crude oil. It just seems like the money isn't real confident. I think we can kind of point to maybe 2 things. One is the southern hemisphere. Let's start with the bigger one. China worries about their economy and whether they're going to come in and be robust buyers. It's looking more likely they're likely to be just-in-time buyers. Stay with that approach, and that probably means that we're not going to see the corn export sales just all of a sudden magically pick up. And then there's an unless, and that's number 2, South America. Now, private firms yesterday were downgrading some crops a little bit in Brazil. Southern states a little bit dry. Argentina, certainly that's share of woes. Talk about 40-year impactful droughts. But still, the core of Brazil, hard to find anything other than expectations for average or above average crops with acreage increase. So we really don't have anything there. And then probably the third thing here is just when you look at things historically, they're at a high price. So when you push beans over $15 to end the year, you better have some fresh new news to maybe keep buyers active. And other than filling a gap, to me, it looks like the funds added a lot of corn last week, a lot of beans. They probably ran their stops up pretty tight. And when some of these markets tipped over, these stops got triggered, and it's just like a dominoes. Everything just keeps falling with it. And I think Jesse, that's been a big part of this was, I'll give you a real quick example. I know I'm a little wordy here, but corn on Friday's committed trade report had added 45,000 contracts up through Tuesday. Then corn was up Wednesday, Thursday, and it looked like in those days you'd see corn up 3 cents, drop 2, then go forward and drop to 3. Told me had layers of buy orders underneath the market. Well, you get what I call unintended sales. So when the market tips over, these stops hit, those are sellers. Nobody really intended to sell unless it tipped over. Well, it tipped over, so they're selling. You may have those who are selling to exit logs. You may have those who are selling to initiate new positions. And then you get another type of selling, those who, took the chance and sold, let's say, into the weekend. They come in and say, hey, we're making money. The trend is turning down. The indicators are pointing lower. Let's sell more, because they've kind of got, quote, I'm going to say, quote, house money to work with. So you get some selling that develops that really wasn't anticipated unless things went lower, and they went lower. So it accelerates.
Yeah, no, and I appreciate the explanation there. I think a lot of folks will appreciate that explanation into what it appears that we're seeing in this market, Bryan. And you mentioned a lack of fundamental news and feeding the bull, so to speak. And it just doesn't feel like, outside of the things you mentioned that are weighing in the market, there isn't much else out there as we prepare for the January World Agricultural Supply and Demand Estimates report next week.
Right. So you've got that report out next week, and I don't think anybody's expecting some major bullish surprises. The obvious question is, where do they come from? The January report in recent years maybe had a little bit more bite, as it seemed like there was a disconnect between the November yield estimate and then the final estimate in the January, where people are kind of scratch their heads and say, well, it's not out here, or the test weight is. So it looks to me like this year the market may have already sort of massaged that yield expectation. Now, it can change, but if we think about it, we had decreases in yield in September and October, and then in November we had a little increase. So we're already seeing kind of the massage. How much more do we change this in January? I don't know. It's anybody's guess until the USDA puts the number out there, but I don't think we're going to find a surprise feed usage number. That's bullish. I don't think you're going to find a surprise export number, because we monitor those weekly. So I'm really strapped to see where news comes from to really give my give the market a boost higher. So
Do you think, as well, with the calendar flipping to a new year, I've heard some whispers of some increases in farmer selling. I wonder if that's maybe adding into some of this pressure that's maybe in the market from funds with taking off some of their unintended sell signals, et cetera here.
Oh, I think so. And I talked to, I relayed this to other farmers, or if I had other interviews, that as I was talking to farmers in the last week, a little better weather to move grain. But, I was hearing things, hey, there's a long line. People are moving. So I think that the bounce back and time, because farmers had time in their hands, starting the core bins, there was some stuff moved and maybe sold. Uh, we looked at the March contract as an example in corn. So it bottomed at 635 here recently, just a sliver over that, and then rallied up to 685. That's a 50-cent rally. So, I'd have to be of the mindset that if somebody said, hey, here, and we lost, we toyed with $7 and we got down to 635. So that is what, a 65-cent drop. Hey, if you could get 50% of that back, 50 cents of that back, would you sell? And I think a lot of people said, yeah, I think I better do that. I don't want to get greedy. So I do think that was part of it, the increase in both corn and soybean selling last week.
Well, and I wonder too, if I'm a producer who, didn't really pay attention to the market last week and didn't take advantage of some of that rally, and now we're losing some of that rally here this week, and they're going, oh man, I wish I would have made some moves. I think we got to put into perspective that we still have very good prices out there, Bryan. So it makes sense maybe to look at making some moves or getting some floors locked in, especially ahead of this January report, which is typically a big report. And who knows, the USDA could throw a surprise out there that we're not anticipating.
Right. So the old saying is, you got to feed the bull. We kind of mentioned that. It doesn't take anything. Just gravity can pull a market down. So I worry about that. And to your point on what news we do get in general, it's been this steady sort of bearish news. I'm talking about export sales. We don't also go, wow, man, I think we had 1 week, maybe 6 weeks ago, where Mexico, or 8 weeks ago, bought a whole lot of corn. Otherwise, it's been pretty tough. So to your point, these are high prices historically. Do we sell a lot of corn? I don't know. I don't know if I ever really buy into this idea that we just sell corn at the first for tax reasons. I mean, you can sell corn, for the first and take your check after the first. So I read an article or blip today that farmers may have take be receiving 3 times as many, either as many checks or amount of checks now that the year's flipped over. And it was just corn that was delivered. So I'm not so sure you have to deliver more corn, but there's still an army of farmers out there that still will, start thinking it's winter. I've got to start moving corn. I got to so there is that natural progression just to keep busy, keep your trucks moving, you're moving corn. You've given the market an opportunity to rally. It really hasn't done much if you've been holding it since harvest. So it's, I'm sure there's a whole contingent of people that are saying, I just need to start moving it anyway.
Any quick thoughts in grains, new crop side, if producers are looking at locking in various inputs here at the beginning of the year, anything like that? Obviously, they hopefully would lock in some profit on the grain side as well. Any thoughts, any changes to your new crop strategies right now, Bryan?
Well, I just say keep your marketing tools, available in front of you and keep sharp. I'm always a big fan of that. First, anywhere you're comfortable, I'm going to say number, but 15 to 35%. That if you have a value, whether it's 2 months before harvest or 10 months before harvest, and you think you can make money at it, well then sell and hope to be wrong, and sell more higher if that happens. But if that's all the market musters, and I'm worried about that this year, then it's a long slippery slope. So look at all your tools. Look at things like in corn, buying a put and selling a call, or maybe a couple of calls, or buy a put, sell a put. I've got a strategy. It's kind of layered, but it's buying a put, selling 2 calls. There's a lot there. So don't anybody just go out, run out there and do that. You really understand the risk and the cost or the benefit, or the perceived benefit, and what the goal is with that. But those are things farmers should be thinking about at this time of year. I want to just keep everybody grounded in reality. Back in June, the market lost about $1.85 in less than a month. So regardless, it was dry and hot in areas, and the drought monitor map, the market still blew out. So if the money just decides that we don't think it's a good investment to own corn, or we think it's a good investment to be a seller of corn, you know, uh, it's cruel, but the market doesn't care about your break even. It does in the long run, but not in the short run. So in the short run, though, you feel the pain of the what ifs and holy cow, this is real. Um, so that's where that sits.
Bryan Doherty of Total Farm Marketing is our guest analyst here today. Bryan, let's move over to livestock. This cattle and hog market, it was a down day in feeder cattle and hogs, especially Thursday. Live cattle were mixed to lower. We had a really strong day Wednesday in feeder cattle. I'm just wondering, what's your thoughts, this tone of this cattle market here as we start the new year? What are you thinking there right now, Bryan?
I think the cattle market still is bullish. I hesitate when I say that because um, when I think about what this looks like on the economic front, high prices, inflation, is the consumer going to chew up beef? And uh, it seems like consumers may be backing away from, I'm going to say, bigger ticket items. And I just think about some of these messes we've seen, like with Southwest and and people traveling in the middle of winter, and you don't really have a vision of booking a cruise anytime soon. You look at inflation, but I think people are still going to eat well. I just get that gathering. So I want to think that demand is still good. It's a supply driven market. We know we've got tight supplies. The question is whether we can get that extra boost of demand, in particular from, let's say, Southeast Asia, that part, all of that sort of region of the world. And so far, it looks like we can. Despite a high dollar, the need to feed is
Mhm.
important. And so I'm going to stay with a friendly tone in the cattle. It'll be volatile, no doubt. Um, that's why we use puts. Put put floors in the market with the right mechanisms. Leave the top side open.
About that hog market, any thoughts
Mm.
there? A few differing things I would assume from cattle right now.
Yeah, a lot of volatility there. When it looks strong, and all of a sudden it looks weak. When it looks weak, it comes roaring back. A lot of volatility. I think the front months are trying to figure out where this cash market is expected to be, and you've got the index. still trading just a little under $80, and you've got February, today at 82.52, but that's come down a long way. And then you go to April, you're at $92. So tough to get overly optimistic without the cash index moving, but the volatility I'm talking about is here on the 28th, we had Feb Hogs 91, about 91 and a half, and peeled off, $9, just lickety split in a week. So that just proves the volatility when the cash doesn't necessarily lead the rally, that the board keeps getting ahead of cash and then has to take a breather and come back. This is the second time now that's happened here in the last couple of months. Yet summer months, well over 105, trying to find their way. New contract highs recently posted. Want to stay with a long-term friendly view on that. But again, to a point, we have to see what it looks like. Super Bowls out there might argue that you're getting the right mix of trade activity to form what's called the right shoulder of an inverted head and shoulders formation. Really gives you a bullish perspective over 115 on summer month hogs, but I think that's getting over our skis at this point. I just wanted to point it out, though, that there is a formation there that somebody may buy off of.
And Bryan, we haven't had an update in the dairy market here in a little over a week. As I take a look there and see a little bit of green on the screen from Thursday. But what's your thoughts of what's going on in dairy right now?
Yeah, we've talked about this before, and the global dairy trade here down. I think it was 2.4% here this last report. The two last milk production reports increases on the December report, which revised November numbers. There was a revision upward of the October numbers. And then there's this, again, kind of this malaise in demand that it just, got to a certain point. So I'm kind of strange in that I think that cattle are supported, but I can't really find myself finding any argument for milk. And I think it just boils down to that it looks like, if you summarize, you've got demand roughly down 20%, cheese, butter, especially in cheese and butter, and then escape me whether the blocks are down 20% and then the barrels are down 12, or vice versa, doing that from memory. But the point of it is, you've got declining product values. At the same time, you've got increasing, one, cows in the cow herd, and two, milk production per cow, up 17 pounds per month versus a year ago on the December report. So you've got increased production. So you've got increased production at a time window of economic instability, higher interest rates. And so the dairy industry did what it does well. It figured out how to become more efficient, more milk per cow, and it figured out how to produce more. And consequently, you got a downtrend in prices. And I don't know if we've reached our low yet. I'm a bit concerned that producers bypass $20 and $21 milk because they want it 22 to 23, because the last time it sold $20 and $21 milk, it hurt them. Now all of a sudden you look at things with a 18 and a 19 in front of it.
Plenty of things to consider. Bryan, if folks want to reach out to you and have a conversation as they're getting into the new year here at Total Farm Marketing, and they want to talk about their marketing plan with you, what's the best way to reach you, Bryan?
Just give us a phone call, 800-334-9779. That's number one. Number two, look at our website, totalfarmmarketing.com, or shoot me an email. That's Bryan with a Y. And that, if you call in to ask for the Bryan with a Y, we got two. But Bryan at totalfarmmarketing.com. And love to field any questions or listen to you and see if I can't bring some value to a conversation.
Well, we appreciate the value you bring to our conversations here on the show. With that, Bryan Doherty, Total Farm Marketing. Have a great week, sir, and we'll talk to you again next week.
Jesse, thank you again. My pleasure. An honor to be here. Wishing everybody a happy and safe new year.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.